So the main topic today is how do you hone your investment thesis? And primarily, I'm going to cover a simple framework that you can go through. Patrick already made a quick introduction of my background. I joined 500 2011. That was back in the days when we just started doing international investments. So I brought in a lot of the new deals, for instance, like the first deal in Brazil, the first deal in Spain, the first deal later on in South Africa, and a lot of those gave the footprint of our international investments that we have. We not only invested internationally into the companies, but also we used San Francisco and Mountain View, which is the Silicon Valley operation, as a launch pad for a lot of the international founders. And particularly, the first thing I wanted to dive deeper is what a very good investment thesis look like, right? And what it is. So ultimately, it is a declaration of who, what, why, and how you'll be successful. And very often, especially if you're raising a fund, it's how you're going to generate returns to your investors and limited partners. So having that clarity is very important. And most of the time, and a lot of us are raising fund one. In 500 startup case, we raised four global funds before, overall 19 funds altogether, but still it always continues to prove what you wanted to accomplish, because the fund cycle takes 10 years, particularly if you're talking about early stage investment. So when you look at this sort of first definition, it's unproven most of the time, but you aim to prove it at the moment that you are pitching your investors. And a very good thesis, there are a couple of components there. The first one, and in my opinion, one of the most important, is that when it's very well defined, founders will look for you and they know what you're looking for. And other investors and the rest of the network and ecosystem can refer companies to you because your thesis is declared very clearly of who you are, what type of investments, why you are the best to do that, and how you're going to accomplish those, right? So a good thesis would allow the broader network to know what type of deals you're looking for. And then the second component, when very well defined and differentiated, investors would want to give money to you so that you can deploy that capital. It will also guide your investment decision into the startups. In all our training programs, we also talk about opportunity assessment. This session, I'm not going to dive deep into the selection process. It's just more on the framework of the thesis itself, but it's very connected one to another because the thesis basically will define often what type of startups you're looking for. And please keep in mind that it really evolves over time. In my 8 years of experience at 500, I definitely have evolved my investment thesis. And the reason for that is the market dynamic changes. So where we see opportunity also evolve. And then within the team, we also change and hone our thesis sort of throughout. I'll give a couple of examples. So this is almost like an elevator pitch, right? And the first two examples that you see here, basically you see an evolution of Union Square venture investment thesis. In 2011, the example here is they wanted to invest in large networks of engaged users, differentiated user experience, and defensible thought network effect. And at that time, marketplaces are like the new thing, right? But today, it's much harder in 2015 or in 2019, it's much harder to find sort of broad network or broad marketplaces because a lot of them are well established. So when you look at the evolution, it says as market matures, we look for less obvious network effects, but for infrastructures for the new economy and enablers of open decentralized data. And often that sort of capture, for instance, the trend for like blockchain and so on. And that's really because the market, especially the tech and the mobile market, is so dynamic. So a lot of the learning and where the new trends is happening, it's sort of capturing throughout our life cycle of being a fund manager. Other examples that I think it's very clear, and that defines where I was talking about what a good investment thesis look like. It's because people would know when to refer someone to them. So for instance, on the SaaStr fund, they state pretty clearly, we look to invest in SaaS companies, typically once they have at least 10 affiliated customers, and we invest from $500,000 to $6 million. We have done it. Founders helping founders, investing, providing VP and candidates, promotion, and endless support. So for instance, when we have the founder that graduate from our accelerated program, it's very clear when to send something to them because they are clear of like they want to make sure there's a minimum customer base and the investment check size is also very well defined. And their value add to the company is also very well defined. So very often in a simple paragraph, you can define clearly your investment thesis. And the more, it's almost like when we tell founders to train their elevator pitch, it's very similar for us running funds. The last one is the 500 component. We believe a large and diversified portfolio of early stage investment reduce risk and maximize potential return relative to traditional VC fund. So at 500, for us, the large portfolio going early in the market, it's the important component of building our thesis. So diving a little bit deeper on each of the framework component of who, what, why, and how. So we're gonna use 500 as a case study to look at the who in each of those components. So within 500, we look at operators and also people who have large network connections. So when you look at this network of investors that we have, collectively, we founded over 30 companies and operated in 11 different industries. Not only that's sort of part of the team, we also rely on a broad network internationally. So when you look at who, we wanted to make sure that we have people on the ground, whether they're in Mexico or in Turkey or in Thailand, really in different parts of the world, to be very close to the founders to make sure we can find the best deal flow there. And we use this as a team to define very good deal flow for us at the global level. So the second component of the framework is what. So really, what are you investing in? So a couple of questions here to guide, right? So for instance, what does a target investment look like? It can range from your average check size to sometimes people define specific valuations. So there are a couple of components added to that. And then it's very important to start writing, having your own list of questions of what's gonna help you define a clear yes or no decision. In the very early stage where we invest in, a lot of the meetings take probably less than an hour or an hour average, and then you are going to get as much information about the team, about the product, about the market opportunity that you have. So having very well-defined questions that you want to make sure you ask the founders so that on decision on your decision, it can be faster and can be more sort of crisp and hone in. Another component, people often say, oh, I like companies with traction, but do you know when you see it? So also having that framework, particularly if you have interest in certain business model, understanding what type of growth rate, what type of metrics that matters to you, it's very important. And then often you not only write the first check to the founders, you should also decide when and whether you're going to write those follow-ons. So what we are measuring here is actually making sure you have clarity. We have a funny picture here. It's whether you have clarity of identifying the horse from the unicorn. The next sort of component, like when you look at what we are investing within 500, we are very broad, right, on our industry. So on almost any sector industry, we're one of the most active investors. And that's also because part of our thesis is to have this very broad portfolio. So this is a list of where we have portfolio companies that we feel quite good about in terms of their traction today and their growth. And because of the large portfolio and because of the deal flow and the activities that we run at a global level, in terms of how we define as sort of progress on the win, is that we have currently 10 companies that are valued over $1 billion. So 10 unicorn company that we have in portfolio, and then over 65 companies that are valued over 100 million to 900 million. And we call them centaurs. And a lot of them over the years, especially in the 10-year cycle, they move from being the initial valuation for companies that come to Silicon Valley. They're valued at $2.5 million. All of the companies, for instance, that join our accelerator batch in the Bay Area is in that valuation, and then they progress after. So for instance, I work very closely with TalkDesk. They are Portuguese founders, and they joined our third batch of accelerator, and after 7 years, they are today, with their latest round, valued over $1 billion. So it's really amazing to see founders progress from one stage to the others. And then we're gonna talk a little bit about how this funnel looks like, because for us to find the 10 unicorns, we know that the chances for that, it's pretty low. And then the third component that I'm going to cover is the why. And it's really important for, especially for your team and your investors to, especially for you to define very clearly why you will be the best team or the best investor to execute the plan that you have. If you're not raising money outside, even for you to define like why you differentiated, what's your superpower, it's very important, especially in the journey of being an investor. So for 500, for us, is that we're a Silicon Valley global brand. It's very important that we are in multiple cities, because we believe that the future of a lot of the future growth and unicorn companies and opportunities are international. It has moved significantly. When we started, majority of the unicorn companies were in the US. Now they are moving abroad. You have majority of the new unicorn companies actually are in China. And in the past 5 years, Southeast Asia have 10 new unicorns. In the past 5 years, Brazil, for instance, also have 5 new unicorns. So it's just really interesting to capture this trend. We captured back when we started in 2010. So broad level, these are some of the numbers that we have. And then the fourth component, which is one of the most important too, is how are you going to execute all of this sort of plan, right? So having a very clear investment allocation strategy is very important. So the few questions you should make sure you have. One is, what is your, so how long is going to take you to reach liquidity? Is it 3 years? Is it 5 years? How big would that be, right? So your entry valuation and your exit valuation really matters, because that's going to calculate on aggregate your return. You want to also know like how long your investment cycle is. I would say typically for majority of the funds, it's somewhere between 3 to 5 years. In the case of 500 startups, each of the fund invests in like a 3 years cycle. That means that we're writing our first check in the first on the opportunity of managing the fund takes at least 10. And then the timing for the capital to be returned. So whether you're looking at making sure you return 1x of the capital in the next 5 years or 10 years, and then the full return is going to be of 2x or 3x or 5x in 5 to 15 years. I would say typically in the early stage funds and venture capital, our terms are 10 years, and then you can renew up to another 2 years. So majority of the investors would want to see return no longer than those time frame. So here I put like a simple allocation. So let's say you have a $10 million for investment budget in the next 5 years, right? So what's important for you to start writing it down is then to say how many first check you're going to write. So this is sort of a simple math. We said we're gonna write 100 first checks of $50,000, and that will require $5 million. And then I think when I project is that 20% of that first check is going to raise a next round, and I want to write $250,000. So that's going to require another $5 million. Of course, this doesn't account for like the management fee. You want to make sure those are counted in your overall budget. But just to simplify is you want to make a model to make sure when you're writing and how often you're writing. And the numbers you see here at the bottom basically is 1 out of the 3 deals, you continue to write another check, right? So let's say if you write 50 checks, just on the random distribution, you do around like 15 follow on to that. So like making an assumption in that stage of how big your portfolio is going to look like, how much you're going to write for the first check in the companies, and you writing follow on, it's very important, your allocation strategy. So when you have those entry valuation, exit valuation, you can then calculate, for instance, the total return that you have. So this is a theoretical model of a fund size of 150 million. So for instance, here we calculated the total invested capital here. And basically, when you look at the sort of this component, we decided that for our $150 million funds, we are investing in 680 companies. I know it's a large number, but 500 startups invest in a lot of companies. So our portfolio actually is 2,000 companies that are in portfolio. So for instance, on a theoretical model of like around 600 companies here, we came up with a model that says about 2% of the companies is gonna have over 50x return. And around 5% of the companies is going to have 20x return. About 10% of companies going to have 5x, 23% is going to be 1x, and 60% is going to be 0. And then we calculate what that potential return looks like and what the fund multiples would be, right? And this is also something that we evolve over time. So for instance, this slide, it's the funnel from the first 2 funds that we have. So when you look at fund 1 and fund 2, we invested in 600 companies collectively. They are all in the pre-series A, so in a very sort of early stage, and about 30% raise the next round. And then 15% raises the series B, only 6% raise series C, and beyond is only 3%. So when you look at the funnel gets pretty small. Early on, I show that slide, we have the unicorns at the centers. It's a small percentage of our company that gets there, but when they get there, actually they create a big return sort of collectively into the fund. That's why when we do the modeling, the slide that I just shown before, it's important for you to come up with your model of how you execute that, right? Like what is the percentage, however your portfolio size is, right? Whether it's 30, 50, 100, 600, 2,000, 5,000, like how many companies you believe it's going to make a big return for you. And I want to highlight, we often talk about the investment component. Investing is just one part of the equation. And it's at that moment that you're making investment, but very important is what's happening before on making sure you have the best deal flow. And then on the other hand is after you invest, those companies never go away. They stay with you, they are stuck with you. So you need to like really design and think through what type of value add you want to give to founders. And if any, you can say my value add is I'm like the first angel check investment, I'll get out of the way. And if they need something, they'll come to me, but I don't need to do anything. But you can also define, that's in the case of 500, we decided that we want to use the accelerator program. And often when we run the ecosystem activity, for instance, like a lot of the partnership we run with the corporates, the idea is that we can make closer connection to the companies so that they can find additional clients to them. So we decided that we wanted to build value add as a network, and that way, when founders join us, they can access the 500 family. And with this, you need to then make sure that matches your team, right? If you have 2 people team, it's going to be very hard to have a very large portfolio and still do a lot of value add or take a lot of board seat. So we decided not to take board seat because maybe the right number that in the market people say you can take per person, per partner on the board seat, it's 7 boards, right? So let's say if you have 2 people in a simple math, that would be 14 companies in your portfolio. So you want to max it out maybe 20, but you want to make sure that when you're sort of closing this cycle, what you're offering out there in the value add really is consistent with what you offer and your team size there. Very quickly, as we're approaching the 30 minutes, these are a list of activities that you can do to have the best deal flow. In the VC Law program, we dive a lot deeper on how you accomplish those. In a very high level, things that have worked quite well for 500, we are very active in the community component. So for instance, and because we have this global footprint and not only being in the Valley, so for instance, we did a Unity and Inclusion in Miami event because we wanted to make sure we tap into underrepresented founders in like the Florida and South US. And we do a lot of different community engagement because we believe that's a very good way for us to find founders. So we're very often in like speaking events. We keep our also blog active because writing is an important component to build your brand there. So there's a very important component I want you to focus on is once you know what your investment thesis is, make sure you put it out there, because that will help you attract the deal flow. And most of the investors are going to ask you how you're going to win, and big component is how do you going to trust the best companies to come to you. Make sure you create your own sort of questions and opportunity assessment. So build your framework to how to evaluate those companies. I'm not going to dive too deep on this. What you also want to make sure here, just one thing I haven't spoke before, is how do decision making happen at your firm. So often you might have a framework and opportunity assessment, but you want to also have it very well defined on the investment decision, whether you want consensus, whether if you're in CVC, if you need to have board approval for that, is that consistent with the timing of the companies that you have in. So make sure that you have a couple of framework assessment very well defined. And then this is the final slide, and I would like to open for question and answer, and we can dive deep on any of the slide component or broad question that we have. This is a case study, particularly Pocket and Elizabeth, both of them joined our first VC Unlock Silicon Valley, which is the one that we run at Stanford. And they decided to build pretty differentiated investment thesis. And they built that during the class. They met, they didn't know each other, they met during the class. And then they said, we want to tap into the millennial cross-border network and invest in early stage companies, right? And there is no other fund that I know of that built space on that. And very quickly, after defining their thesis, in Elizabeth and Pocket both are very prominent on writing and also doing community activities. So Pocket runs this community called SoGal community, and Elizabeth wrote this sort of LinkedIn article that went on viral, basically talking about sort of the young sort of next generation of VC, and there's no one or nothing out there with their profile. And they were able to raise the fund. They've been investing actively in people like them. And I feel like that's something that if you have a very clear thesis and you start putting your word out there, and of course you have to work a lot and hustle a lot, it's very exciting to see opportunities like that from a fund perspective over the years. So this is the last slide I have before we open for questions and for Q&A. And I'm gonna hand it back to Patrick.
Awesome. Thank you so much, Bedy, for that insightful webinar. I trust everyone now knows all there is to know about investment theses and how to create them, and some tips about honoring them as well. However, if you're still craving info, now's the time to ask your questions. So remember, if you have not already done so, you need to submit them in the Q&A tab at the bottom of the screen. And I'm going to moderate them. And normally we don't have time to get to all of them, so hopefully we can get to as many of them as possible. And I'd like to start with a question from Imran Dean. And Bedy, you mentioned in the first slide that your thesis is unproven most of the time, but you aim to prove it. How much of the thesis should come from market data and analysis with trends?
Yeah, that's a great question. It's very important that you have the market trends and the market analysis. The next question that I'm going to ask you to add to that is then why you can execute that, because probably you can pull that data and I also can pull that data and another 100 people can pull that data, right? So the data really help sort of hone in where the market size of what you want to invest in. but also make sure that with that, you always have a, like very close to that, it's why you and what's your superpower.
Great. And this one is from Kimmy Paluch. How important is it to have an investment committee in your investment analysis process and investment thesis process?
I think depends on your check size. I would say for the early stage, for instance, I'll give you an example, sort of more active for 500 startups. So for us, it's more, we have a committee. We definitely have a committee. For follow-on, we need consensus on the committee because follow-on, often we're writing bigger checks, 250K, maybe $500,000. So that's sort of a bigger check for us. For smaller check, $50,000 to $150,000, we make sure it's fairly independent, but we need to share with the committee, and then no one can hate a deal. So it's not really a consensus. It's like, can you get away with wanting to invest a deal that no one hates it? And of course, the discussion, especially if you have a diverse group of having different opinion, it's very important. Because at the end of the day, if it's a very obvious investment everyone is seeing, that outcome is not going to be huge. Normally, the biggest deals in the biggest outcome that we have are the non-obvious, and the non-obvious deals are more controversial. So use the committee really as a way to get a lot of different position on why is this an opportunity, or is this really an opportunity, or is that a risk? So internally, we find the committee very important, but we don't need consensus for the first check, but we need consensus for follow-on. So in a nutshell, I would recommend for smaller checks, if you make the decision process very hard, it's going to take very long for you to approve a lot of the smaller checks, and then time, not only for the founders, but your time is pretty precious.
Great. And so this is from Jacob. Does the investment thesis remain static over its lifetime?
Sorry, can you repeat that, Patrick?
Sure. Does the investment thesis remain static or more dynamic over its lifetime?
Oh, yeah. The investment thesis evolve, but it depends how narrow or broad your thesis is, right? So when you look at 500 investment thesis, is that we are systematic on investing in large portfolio and follow on when the companies are working. That's like broad enough to stay static. But a lot of people, and I'll give you an example because we have thematic funds, and one of our sort of thematic fund is the mobile fund, and that's from Edith. She evolved her investment thesis a lot because she's always following the next trend. So it's called the mobile fund at the beginning, but the next trend that she was following was on VR and AR. And then like most recently, she was investing in blockchain. So when you're catching often the edge of technology, that comes and go. And then you need to make sure, and that's sort of an art than anything, you want to make sure that when you're defining your thesis with your investor, it's very clear to them, like, if your thesis says, I'm capturing the edge of the next sort of technology, that's broad enough, right? But if you say, oh, my investment thesis on VR and AR, and then like that, you don't see a lot of deal flow, that no longer is your thesis, then you need to sort of evolve to that. And a lot of alignment with your LPs on, it's very, very important. So I would say it really evolves because there's a market trend that we're capturing. If you're defining the thesis broad enough, then you will always capture somehow. But the focus and the narrowing, like today, it's very hard to build something very broad, right? Because you have enough people building broad theses that they are the first comer to that. So I would encourage, as you're defining your thesis, to be more specific. so that you know what you're looking for, but on the other hand, not too narrow that like when it changes, your thesis fall apart.
Great. And now, so how does 500 and how do you manage your time and resources on failed investments, which are oftentimes the majority of deals?
Yeah. We don't manage the companies that are failing. I think what you will often see is, and that happens to majority of the investor, you want to actually be spending time with the companies that are doing quite well, but normally they don't require a lot of your time. And then the companies that might be struggling is where most of your time sort of it's needed. Because we have a large portfolio, we focus a lot more on making sure the companies that are working continue to work. I think with the companies that are failing, there's a psychological component that it's often important to give to founders. What we sort of try to make sure that the founders are, I think sane, it's like not the right word, but have like the balance, because it's very hard for founders. So we try to make sure we're available for them, but we don't try to, like a lot of people like try to manage companies that might not have a direction and they do 10 other things for them to work. We try not to take that role, and then we also don't promise to take that role. So at the end, I think it's important for you to know like whether you like where you want to spend your time on, and like make sure the expectation with the founders are clear. And the way that we sort of manage the large portfolio is we don't take the board seat, but on all of the deals, we ask for information, right? So we want to know when the company is raising a new round. And then we ask for pro rata right for the accelerated deals that we have, because we often are the first check. So we want to make sure there that we have the information and we have the ability to invest when they're raising and it's sort of working in the company. So we try to manage the information more than anything.
Great, and there are a few questions about this topic. So in terms of what is new VCs and folks that are just raising their first fund, what advice do you have for them in terms of establishing a thesis without a track record?
Yeah, so I think there are a couple components that it's quite important. For instance, that's how I got into the sector, and I think a lot of people get into the sector that way. One, it's whether you have any particular industry expertise to that. So I would say like the team background is often what people look into that. And to give you an example, in my case, I built a network in Brazil that gave me deal flow access to founders. So for instance, I didn't have a track record, but I built a brand that if people wanted to access any founders in Brazil, they would come to me. So although not having a check to deploy, I have access to a network that it was differentiated. So my suggestion is to start looking at what is going to give you a differentiated deal flow. Because before I was saying like investment just part of it. So you don't have the investment, you don't have the value add after yet, but what you can control is have a deal flow that other people would not sort of have access. So that proprietary deal flow is the most important component. And that's also how we select the individuals that come to our VC Unlock program, because we have the Silicon Valley, which is the Stanford program coming up. And ideally, you have a portfolio that we can look at, but not everyone has that. And you have to start somewhere. And the starting somewhere often is the hardest, right? And I would say the best way is by having companies and deal flow in the trusted network that will go to you. And then your background sort of differentiation of like whether it's geography, whether it's industry, Those are quite important, or a technology. Some people have like specialty in technology component. Those are quite important also in sort of tapping into the investor path.
Great. And this is from David. What is our decision basis for deciding to follow on or not? Obviously getting to Series A next round, but what is 500 and what do you look for?
Yeah, a good question on the follow-ons. We actually, that's when often I mention like the thesis evolved, right? When we set up the fund, we thought majority of the follow-on would be during the batch. So what that means? It means that company comes in, we give them the first, I don't know, 50 to 150,000. At that time, it was like 50,000. And then we thought, oh, now that I've seen you after 2 months, I'm ready to know whether I'm ready to give you a follow-on, because very clearly you see in the first few months which team are very dynamic, they get feedback really well, they're getting early traction, and which are not. So we decided at that time we would have a lot of the follow-on before the end of the batch. What we realized over time is that unfortunately that 2 months wasn't enough for us to have enough input. Also, it gave a lot of market signaling that we didn't want to, because what happens to the companies that we didn't say we're going to follow on during the acceleration program? What would the rest of the market think? Like, they're not good companies. So we changed significantly afterwards on how we deploy the follow-on, which is we actually wait for the signal from the market, which is they're raising around in the market, and then we follow on with them. Sometimes it happens that the market, and because Bay Area, you have enough investors. So sometimes in the markets like Bay Area, you have enough investors that the market, it's pretty, I wouldn't call it like perfect, but it's pretty dynamic in the sense that if the opportunity is there, investors are going to jump in. I think often in a lot of international markets that we sit in, 500 needs to be a little bit more proactive. Because people are afraid to be the first one, right? So if we always wait, founders would never raise the round. And we saw that like early days in Brazil or Mexico, we just didn't get follow on in the companies. Today it's very different, but like a few years ago, 5 years ago, it was different. So what we really measure on when we do the follow on is we look at their metrics for all the companies, and I would encourage everyone to dive deeper. There are a lot of information out there. We also dive deep in the course. It's depending on your business model, look at what metrics that matters. So for marketplace, it's different from e-commerce, that is different from SaaS. And then what are the numbers that seems at a good sort of growth rate, right? So if a company in the SaaS industry, it's making $1 million and then having a 3x growth year over year, we know that that's a good number. So even the local market is not doing anything, we would signal and do the follow-on investment. And what we've seen often, especially in markets that are not that mature, it's because 500 does that investment, a lot of people join and the founders can put together their round. So because we have this global portfolio and now we can compare, for instance, something that has happened in Brazil, then later on is happening in Turkey, then you can compare that with Indonesia. That actually help us get a very good baseline of the different profile. And we do share that among the investment partner on the discussion.
All right, so the few questions came in specifically about LP management. So the first one is there a preference among LPs with regards to format that they receive thesis in, slide deck versus some business plan or even just a conversation?
Sorry, I missed for a second. It's what do people look at? Can you repeat?
Yes. So how do LPs prefer to learn about the thesis? Is it through a slide deck or some sort of business plan? So how do you share your thesis with LPs or potential LPs?
Yeah. Yeah, it's also a very good question. Just like with founders, you appreciate the founders when you all have to raise money. They always say, the LP always say it's also like a relationship component. You have to start somewhere. I think we classify the investors in a lot of different type, right? So for the institutional investors or the investors that have written checks to other funds, I would, in those cases, we are normally pretty straightforward because we know they're actively looking, and then they can compare, and then we can pitch them, we can like talk to them about the fund. And then also there is those that are not or have not done investment. That has happened a lot in the emerging market that we're in, but maybe it's family office or the corporates, and they're coming into this venture world for the first time. And then if that's the case, very often there's a little bit of education, sort of welcoming to the venture, the tech world that it's needed. So in that case, we also have a presentation, but very often we don't start pitching it really strongly right away, right? So I would separate investors that are already active, and then they're looking. So having a very good sort of pitch deck and be very prepared on all the due diligence questions this is like really important. And then not for the ones investing for the first time, it's not, but it's just the type of information that they look, the types of due diligence that also make it's quite different.
Great. I think we have time for about 2 more questions, and then we do need to end. So this is kind of another LP management question. So how do you avoid maybe trouble or even litigation from LPs if you evolve your thesis beyond its initial scope?
Yeah, most of it is communication. LPs expect that you have, whether it's annual or biannual LP meeting, and then a certain frequency of newsletter. As you evolve and you see opportunities, most of the time, the LPs are, especially your first-time fund manager, that your thesis, it's unproven, it's the first time you're doing it, they're really investing in you, right? So that relationship they have with you, managing the communication really well, it's important. If you make it very clear of like the shift with the market, actually it's positive, right? For them, it's worse if you just sort of sit there and you didn't see the change coming, and you stay in the old mode, and then all the investments are not sort of great or working. So being able to communicate, because you are in the front row of seeing the changes through the founders. So if you're seeing that most of the founders, a lot of opportunities are there, you can make sure that you communicate to that. One thing that you can add to your LP agreement, which we've done, so you can say a percentage of the companies of that you have flexibility, and it's outside of what you're gonna invest, right? So you can say, all right, 80% of the deals are going to be, I'm gonna give an example, 80% of the deals is gonna be in Latin America, but 20% I can do whichever or wherever I want. And most of them will be okay because you're mapping that. And all of a sudden on the 20%, you say, oh, actually, when you like report your portfolio, you can say, actually, we've seen a lot of opportunities on this. We like to like invest a lot, like we'll continue to invest a lot in those because this is where like the future is looking like. And then sometimes you have to make amendments, right? So for instance, for the mobile fund, they have to make amendment to accept coins for the blockchain that they're doing. So they were able to manage the relationship with their LPs to say, this is the opportunity, we like to continue investing in that. And they say, fine, and we have to even change the structure of the fund so that we can really capture that opportunity. So I would say anticipate communication with the LPs on your LP agreement. I think it's pretty like common practice as a percentage of things that fall outside. And then as you are reporting your portfolio throughout your investments, just share where you see the opportunities are. And then most LPs really appreciate that because they're not seeing that in the sort of in the front sort of battle and that's very often why they invest in you and your fund.
Great. And I love this as a final question from Jagruti. And Jagruti asks, SoGal is a great case study. In your experience, where are the future opportunities that are still emerging and available for new funds?
Great question. I think globally, that's where we see still a lot of opportunities. Overall, at 500, there's a lot of interest when we see from the corporates around mobility. We got a lot of the lot of the interest from the corporates to look at more deals like that. If you're doing early stage, maybe you can be a sort of a deal flow component to that. We continue to see a lot of opportunities in financial service, but I think there are enough funds now that there's international component for that. Having one component that I would also add is being completely alone in the market can be good, but also it sucks because you are the only capital in, right? And very often you want to share the load with other investors. So for instance, when we look at financial service internationally, now we feel like it's an increasingly great space because we have follow-on capital into that. So I think financial service overall internationally, it's a very good space. Also internationally, we see a lot of SaaS companies. I don't know how many funds are focused on that. So like the focus often in a certain business model, it's quite important. The focus on certain technology, a lot of people are interested and continue to be interested in AI and IoT, but of course you want to make sure that you have whether the background, the network into sort of those technology. So those are some of the areas, at least that we see a lot of different demand into that. Blockchain continued to be a good market, but that also requires your fund to be structured in a certain way.
Awesome. Thank you so much, Bedy. That is all the time we have today. So we will be sending out a recording of the webinar to all registered participants. So if you missed something or would like to review any of the slides, feel free to rewatch at your leisure. And again, if you'd like to learn more about investment theses and to expand your knowledge about corporate innovation, please check out our upcoming VCU Paris program from May 13th to 14th. We need you to get your applications in quickly. We only have a few spots left. In the meantime, feel free to reach out to me at patrick.driscoll@500startups.com if you have any questions. And with that, any final words, Bedy?
Thank you very much, everyone. Thank you for the questions and joining us today on the webinar.
Great. And have a great rest of your day or night or wherever you may be.